Jessica Mora stared at her laptop screen at 11:47 p.m. on a Wednesday night, her hand slowly rising to cover her mouth in disbelief. The number glowing on her credit monitoring app made no sense. 740, down from 820 just 3 months ago. 80 points, gone. But she'd done everything right, better than right. She'd done what every financial expert told her to do. She'd paid off every single cent of debt. $15,000 in credit card balances, cleared. $12,000 in student loans, finished. $8,000 car loan, done. After 3 years of sacrifice, budgeting every dollar, working overtime, skipping vacations, she was finally debt-free. Zero balances across the board. And her credit score had collapsed. Jessica clicked refresh on the credit monitoring app, convinced it was a mistake. The number stayed the same, 740. She opened another browser tab, logged into a different credit monitoring service, 738, essentially the same devastating number. "This can't be right," she whispered to herself in the empty apartment, the only sound the hum of her laptop and the distant traffic outside. "I did everything they told me to do." 3 months earlier, Jessica was riding high. She'd made her final debt payment on a sunny Saturday morning in July. She remembered the moment clearly, sitting at this same desk, clicking the submit button for her last student loan payment. The confirmation screen appeared. Balance, $0. She'd actually cried, called her mom, posted a celebration photo on Instagram with the caption, "Debt-free at 28." The financial advice blogs and YouTube videos she'd watched for years all said the same thing: pay off your debt, watch your credit score soar. Debt-to-income ratio matters. Credit utilization should be below 30%. Ideally, pay everything off. That's the path to an excellent credit score. That's how you win the game. So she'd played by those rules. She'd worked a second job on weekends. She'd meal prepped to save money. She'd said no to friends' wedding destinations and birthday dinners. Every extra dollar went to debt. And finally, gloriously, she'd won. She was free. Except the credit system had other ideas. The first sign something was wrong came 2 weeks after her final payment. Jessica was casually checking her credit score, expecting it to climb. Instead, it had dropped 5 points. Probably just a reporting delay, she told herself. It'll correct next month. Next month, it dropped another 12 points. The month after that, down 63 points in a single update. Now, staring at 740 on her screen, Jessica felt something between rage and panic building in her chest. She'd done this to herself, by doing the right thing, by following the advice, by becoming debt-free. She grabbed her phone and called the Credit Monitoring Service's customer support line. After 15 minutes of hold music, a representative named David answered. "Hi, I'm calling because my credit score dropped 80 points and I don't understand why. I paid off all my debt. Shouldn't it go up?" David asked for her information, pulled up her file, and went silent for a moment. "I see. Yes, ma'am, I can see the decrease. Let me look at the factors." "Is it a mistake?" Jessica asked, hope creeping into her voice. "No, ma'am, this appears to be accurate. When you paid off and closed multiple accounts, it affected several factors in your credit calculation." "But I paid everything off. I have zero debt. How is that bad?" "Well," David said carefully, "the credit scoring model looks at several factors. One of those is your credit mix. You previously had installment loans and revolving credit. Now you only have your one remaining credit card. That reduced diversity counts against you." Jessica felt her jaw tighten. So having different types of debt is good, but having no debt is bad? "It's not about good or bad, ma'am. It's about the scoring model. Also, when you closed those accounts, you reduced your total available credit. That increased your credit utilization ratio on your remaining card." "But I barely use that card. I put maybe $200 a month on it and pay it off immediately." Yes, but your total available credit dropped from $35,000 across all your cards to just $5,000 on your one remaining card. Even though you're only using $200, that's now a higher percentage of your total available credit. Jessica stood up from her desk and started pacing. Let me get this straight. When I had $15,000 in credit card debt, my score was higher. Now that I have zero debt and pay off my card every month, my score is lower? The system also factors in average age of accounts, David continued. Your student loan was your oldest account. When that closed, your average account age decreased significantly. I paid it off. I finished paying the loan they gave me. I understand your frustration, ma'am. Do you? Because I spent 3 years sacrificing everything to get out of debt, and the credit system is punishing me for it. David went quiet. Jessica could hear him typing. Would you like me to explain the other factors affecting your score? Please. Your credit file shows you recently closed 2 credit card accounts after paying them to zero. Closed accounts, even in good standing, can negatively impact your score. The system interprets it as reduced access to credit. Jessica laughed, but there was no humor in it. So I should have kept the accounts open? Generally, yes. Financial advisors typically recommend paying cards to zero, but leaving them open to maintain your credit utilization ratio and average account age. Nobody told me that. Every debt payoff guide I read said pay it off and close it, cut up the cards, remove the temptation, start fresh. I'm sorry, ma'am, that's common advice for debt management, but it's not optimal for credit score management. Those are 2 different things. Jessica sat back down heavily in her desk chair. What are you saying? That I shouldn't have paid off my debt? No, ma'am. Paying off debt is financially responsible, but the credit scoring system doesn't necessarily reward financial responsibility in the way you might expect. It rewards consistent, ongoing credit use and management. So I should be in debt? Not necessarily in debt, but actively using credit in a way the system can measure and evaluate. Jessica ended the call. She sat in the glow of her laptop screen, staring at that number, 740. She opened her banking app. Checking account, $8,000. Savings account, $12,000. Total debt, $0.00. She was in the best financial position of her adult life, and according to the credit system, she was less trustworthy than when she was drowning in debt. The irony was brutal. When she had $15,000 in credit card debt, making minimum payments, stressed every single day, the banks loved her. 820 credit score, pre-approved offers flooding her mailbox. Now, with actual financial stability and zero debt, the system had downgraded her. Jessica started researching. Forums full of identical stories. Someone paid off their mortgage, score dropped 40 points. Another closed old credit cards, lost 65 points overnight. A man paid off his car loan early, score plummeted. The pattern was clear. The credit scoring system wasn't designed to reward financial freedom. It was designed to reward profitable customers for lenders. And profitable customers use credit consistently, carry balances occasionally, pay interest, and stay in the system forever. She found a Reddit thread that explained it perfectly. Credit scores don't measure how good you are with money. They measure how good of a customer you are for lenders. Those are completely different things. Jessica had 3 options. Option 1, do nothing and wait years for recovery. Option 2, play the game, open new cards she didn't need, stay in the system. Option 3, stop caring entirely, buy everything with cash. None felt fair. She'd done exactly what every financial expert told her to do, and the system punished her for it. At 1:15 a.m., Jessica made her decision. She'd play the game, but on her terms. 1 new credit card, no annual fee. Use it for groceries and gas. Pay it off in full every month. Never carry a balance. Never pay interest. Keep her old card active with a small subscription. She'd proved to the algorithm she was a consistent credit user without going back into debt. It felt like lying on a test she'd already aced, but if that's what the system required, fine. But she'd also tell everyone she knew, her younger sister, her friends paying off student loans. The truth the financial blogs don't mention. Paying off debt is financially smart, but it's not credit score smart. Those are different games with different rules. The credit system doesn't care about your financial wellness. It cares about your value as a profitable customer. Being debt-free makes you financially healthy, but it makes you invisible to the credit scoring model, and invisibility gets punished. Jessica closed her laptop. Tomorrow, she'd start rebuilding her score the strategic way, but tonight, she just felt tired and angry and disillusioned. She'd thought debt freedom meant winning. Turns out it just meant entering a different level of the same game, and this level nobody had warned her about.